The American Federal Reserve cut interest rates last week, and in an earlier episode, we actually speculated a little bit about what that would mean. Now that it happened, we want to talk some more about what happens when the Federal Reserve cut the interest rates. You're listening to Investing Mastermind podcast. My name is Signe Lundholt.
And I'm Michelle Markey.
So last week, Powell from the American Federal Reserve cut interest rates by 0.5 point, which was actually more than most experts would have expected that the rates would be cut. And that actually meant that right after this was announced, the stock market went through the roof, so to speak. So both the S&P 500 and the Russell 2000, both indexes actually went up quite sharply. But then in the hours after, they declined, and at the close of the day, they were pretty much back to where it opened on that day. But today we're going to talk more about what does it actually mean that the rates are cut, what will it mean in the future, and also, what has Powell communicated about what's going to happen in the future. So, Michelle, what do you think about this rate cut that we saw last week?
Well, the fact that we had this rate cut was expected by a lot of people, and it was due because inflation has come down a good amount in 2024, and a lot of economists had been monitoring the progress of the economy. And the two main things that the Federal Reserve has as its mandates are to make sure that there's price stability. So based on their monetary policy, that prices are pretty stable from inflation, and that we also have stable employment based on unemployment rates. So they're trying to balance an economy based on two main criteria of making sure that we're not having crazy inflation and making sure enough people have jobs who want to be having jobs. And they'd been seeing that the unemployment rate had been going up a little bit, and also they were able to tamper down some of the higher inflation rates that we'd seen in the last few years. So with inflation rates getting closer to 3% or so, that gave the Federal Reserve confidence that they could lower rates. And I thought that they would just lower it by 0.25%. I thought they would take it a little bit at a time, but it seemed a little bit more aggressive that the Fed lowered the interest rates of, and when we say interest rates, we're talking about the Fed funds rate. They lowered it by 0.5%. So instead of aiming for the range of 5.25 to 5.5%, now it got lowered to 4.75 to 5% of the range. So that's going to have a lot of downstream implications that we're going to talk through.
Yeah, so what that means is if you need to borrow money for a house, or if you need to borrow any kind of money, you now, have a lower interest rate, as well as if you would like to invest in bonds instead of stocks. Now the bonds won't give you as large a return as in the past. So for you that's investing in stocks or bonds, that this is what it would mean to you. And also what this also means is that the companies, the big institutional investors that are using their valuation models on how to value companies in the stock market. So maybe they're using the discounted cash flow analysis or any kind of other valuation of the stock market. Then they need to kind of change their projections now that the interest rates have changed, which also meant that stocks were going up because it's the big institutions that can really move the market. We can't, as individual investors, move the market as much as the institutions, but like pension funds, hedge funds. And what most likely happened was that they did some new valuations on certain businesses in the stock market. For example, the businesses in the S&P 500, they are now valued maybe at a higher stock price than in the past before the rates were lowered. And that's why the stock market most likely increased. Was they've been in and evaluating, okay, how much should we pay for this stock, and things like that. And that's what some of the bigger institutions are doing. That's their strategy for buying stocks. So usually what happens when interest rates are cut, then the big institutions does also pile a lot of money into the stock market because now they might not be able to actually get as much out of bonds as they were in the past, and they have to use the money somewhere. So that could be a reason why we saw a sharp increase. I've been wondering, and I actually haven't read anything about it, but I was actually wondering, I was surprised that the stock market actually declined on Thursday after the news came out during the day. The news came out around, I believe it was 2:30, and then it spiked, and then it kind of went down, and I actually don't know why. Do you have any speculation on that, Michelle? What happened?
Yeah, I'm not sure, but in general, we've always heard that as interest rates go down, the stock market goes up. So there might have been that initial excitement from investors that now it's time to put the money in stocks because they will give you more of a return. But then maybe they just wanted to take advantage of some of the sentiment of there could be traders out there who wanted to take advantage of this feeling of happiness that people had that, yay, the Fed interest rates are going down and now stocks should go up based on how that pattern usually plays out. But then maybe they also are doing valuations and realizing that some stocks are a little bit higher price than maybe they should be. And also, the stock market had already been somewhat overvalued before the rate cut. So even though historically rates going down means stocks going up, but how much more up can the stock market go if it's already overpriced according to some measures? So it's a little bit of a weird place to be. And Wall Street Journal had a headline today showing that, sorry, the Fed can't save us from a bear market. If stocks already were due for a tumble and the economy for a recession, the Fed's rate cut probably didn't avert it. So, what that gives us some food for thought is like it's a little bit of a guessing game. What will happen? Like, you would think, oh, yeah, stocks should just skyrocket from here as the Fed continues to cut rates. And that could happen. Or people realize people are starting to lose jobs. Like, there are a lot more layoffs lately. American businesses are not doing so well on some fundamentals. A lot of stocks are actually suffering. So, counter to what you might believe, maybe the stock market is not really reflecting the true state of the economy where it actually is slowing down. And then maybe the slowing down economy will catch up to the stock market, and the stock market could still fall into a bear market, even though there was this initial excitement that made it pop up. But then there's nothing to sustain it. There's no positive growth in earnings to help sustain it for the majority of companies. Maybe it's okay for some of the big tech, like the favorites. Maybe they're able to continue their earnings in a positive direction. But on the whole, probably I would guess that more businesses are struggling in a higher interest rate environment than they are thriving. And it's not an encouraging sign when you see some headlines lately showing that more people are being laid off. Like, that is not necessarily a good sign that the economy is strong. Like, it's okay. People still do have jobs. Like, it's not like you're seeing the most major of companies. If you saw all of them laying off people, then that would be more of a warning sign. But there's another warning sign that a lot of tech jobs have dried up, according to the Wall Street Journal. So if some of these tech companies, they might not be laying people off, but they're not really hiring so much. So what does that say for the future of how these companies will perform? They're not really trying to add people to grow. So that's a bit of a signal for what could be coming in the economy and the stock market.
Yeah, yeah, exactly. And it's funny how the rumors about a recession is still going on, and it's definitely something, we've now been hearing since the pandemic, is the talk about a recession. So it has not happened yet, and it will most likely happen at some point, but we definitely heard that for a long period of time. And as you say, now there's speculation if what was done here, because apparently the US economy is not necessarily ready for that rate cut, but that the Federal Reserve is going to try to come to lower interest rate just to see, okay, are we going to see an increase in jobs now that the rates are lower? I also believe, actually, I did say Thursday a minute ago when I said the rates were cut on Thursday, but it was actually on Wednesday. What happened Thursday was that the S&P 500 actually reached a new high level. And as you mentioned, Michelle, the stock market is super high. Stocks are overpriced in general right now, and the S&P 500 reaching a new high is just, again, it's shocking when you think of that most stocks in the stock market are high priced. Not that there potentially are certain companies that could go through an event that means that the stocks are trading cheaper. Nike went through a decline recently. It just actually increased because the current CEO is retiring and there's a new CEO coming in, which actually meant that the stock price increased on Nike. But they went through an event. So there are certain companies in the stock market that, of course, are going through certain things so that they might actually be trading at a fair price. But when we look across the board, and it's something we've been talking about in the past, if you go check the Schiller PE or the CAPE ratio, you can see that the stock market is overpriced right now. So we're not going to dive deeper into that since we're talking about the rate cuts. What is going to happen in the future, we don't know. It could be a recession that this is going to start, or it could be a new bull run where stocks are just increasing in price, because if the Federal Reserve is going to continue lowering the interest rate, which is what they have communicated or kind of indicated that they wanted to do, then the big institutions would again have to adjust their valuations, which could mean that they would then value companies even higher in the stock market. So what is going to happen in the future, we don't know. At some point in the history in the future, yes, there could be a recession, or yes, the stock market could go even higher. In the year 2000, before the IT bubble burst, we saw a stock market that was even crazier than now. So could we see something crazy happen? Oh yes, we definitely could see things going absurdly amok still. That's just my thoughts. Do you have any thoughts, Michelle, that you also want to add to the chat here about interest rates?
Yeah, some people think that Fed Chair Jay Powell is trying to stick a soft landing in the economy. And when Sina, you're mentioning potential for the economy to go into a recession, that reflects typically the state of people's livelihood. So is the unemployment rate going up? Are there more people who want to have jobs and not enough jobs for the people who want to work? So if unemployment goes up, there's more likelihood that we would have a recession, which could be disconnected from the stock market. Like you could have the real economy suffering while the stock market is in a la la land of just continuing to go up, seemingly to defy the gravity of reality in the real economy not doing nearly as well as what the stock market could be doing. So the Wall Street Journal is suggesting that we could have both a bear market in the stock market and also a recession in the economy. And sometimes they happen together, but they don't always all happen together. There could be a divergence, perhaps, of just differences in what people are investing in, because now that interest rates are going low, there's not much of a better interest rate place than getting your return from the stock market. So if you can't expect to get as much from treasury bonds or high yield interest savings accounts or CDs, some people are reallocating their money naturally to the place where they think they'll get a better return, which could explain why we saw the stock market tick up toward the end of the week of September 20. And that could explain that. But we don't know if the Fed will stick a soft landing. I think there's some people that are very skeptical that that could happen, no matter how hard Jay Powell tries. It may or may not happen. And like some people are saying he's trying to achieve what Alan Greenspan achieved in the early 90s, and a similar softer landing of the economy, and the stock market wasn't too badly affected or something like that back then. But I mean, who knows? We don't know what's really going to happen. And what we should just continue to do is study the companies that we are interested in and figure out when is a good buying opportunity of those, regardless of whether interest rates are going up or down. But what we do know is that Jerome Powell does not want interest rates to go back down to near zero or to negative interest rates like what a lot of the Eurozone experience. So, what we're likely going to plateau at is maybe interest rates going as low as 3%. So, it's not rock bottom, but at least it won't be as painful as it may have been since the Fed started hiking rates from 2022 through 2023. And maybe there will be some reprieve for both businesses and consumers who had higher credit card or mortgage rates, and maybe they'll be able to refinance to a lower interest rate as rates start coming down a little bit. So maybe some things will get better and some things will get worse, is probably what's going to happen.
And I think your reminder for people, to continue to focus on individual businesses is a great reminder to not let macroeconomics impact how you think. Of course, it's a good idea to just follow what's going on. And I must say, I'm impressed by following Jerome Powell on how he's done as chair of the Federal Reserve. He's been through the pandemic and kind of wrangled the inflation, and it didn't. At some point, it was, are we back to the 80s and inflation we saw back in the 80s? And I just think he did a really good job on wrangling the economy. There's a book actually from the chair, Paul Volcker. The title is Keeping at It, where it's like a biography where he talks about what it was like in the 80s and what he did, which is a great book if you want to understand interest rates and also understand the work of the chair of the Federal Reserve, what their role and responsibility is. I really recommend that book. It's quite a good book, and it's a great audiobook. I was listening to it, not reading it. So it's a book that you can listen to and actually get a lot out of. I recommend that one. So we're coming to the end of the show today. And yeah, I really hope you enjoyed it. We're back from the summer holidays and back in full swing now. And we'll be back with the next episode on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.